Guys, let's suppose you want to buy something in the market. You will try to buy it at the lowest possible price, right? Similarly, when banks buy in the market, they buy at discounted prices and sell at high prices. Meanwhile, we retailers end up buying at the highest price and holding on. The real question is, how will we know when the market is at a discounted price or at a premium? When should we buy and when should we sell? In today's video, we will learn exactly that. What are discount and premium in the market? What is equilibrium? What are PDE, premium discount equilibrium, PW, premium weak equilibrium, PME, premium mean equilibrium, weak equilibrium, mean threshold, and consequent encroachment? Before understanding discount and premium, we first need to understand equilibrium. Equilibrium is the 50% level of a Fibonacci retracement tool, or the 0.5 level, which is called equilibrium. The Fibonacci retracement tool looks something like this. We'll study it further. In general life, equilibrium means balance or equality on both sides. Similarly, in the market, equilibrium refers to the level where buyers and sellers are equal, both at 50%. Imagine this market. We draw a line at the market low, labeling it as the 0 level. We draw another line at the market high, labeling it as the 1 level. The midpoint between these two, the 0.5 level, is the equilibrium. Now we have the market's equilibrium. The area below the 0.5 level is the discount area. The area above the 0.5 level is the premium zone. In summary, discount area, it's below 50%. Premium area equals above 50%. Guys, now let's look at the examples of discount and premium. This is what we have. The market was in a downtrend, so we will think of selling here. You will notice here we have a proper leg formed. We will catch the high of this and the low of this. Now we have the Fibonacci retracement tool here. Now this 0.5 level is our equilibrium. Above this is the premium zone, and below it is the discount zone. Sellers are sitting here and buyers are here. You will never see impulsive buying in the premium zone. You will notice that buying is happening slowly, and in the discount zone, impulsive selling doesn't happen. Now we will wait for the market to come here. Boom! The market taps our premium zone. It means sellers were here and became active. Institutions and banks had limits here. Why? Because this is the premium zone. They want to sell at a high price. They sold here. Now let's move forward. Now you will see here a new leg has formed. I will delete all the old legs. Now we will apply the Fibonacci retracement tool to this leg. We will catch the high and low of this leg like this. Now we will wait for the market to enter the premium zone. When it enters, sellers become active. Here, sellers, institutions, and banks sold because they got a chance to sell at a higher price. They will only sell in the premium zone, not anywhere else. Institutions buy below the opening price in the discount zone and sell above the opening price in the premium zone. Here again, the market entered the premium zone and impulsive selling happened. Now we have a new leg formed. We will apply Fibonacci retracement, catch the high and low. The market has already entered the premium zone and tapped it. We can take this entire leg too. This new leg is also a proper leg. We can take it too. Now we will wait for the market to enter the premium zone. It has already fallen from the premium zone twice before because the trend is down. Whenever the market enters the premium zone, institutions stack their sells and the market falls. Now we will wait for the market to act. Now you will notice the market has slightly entered the premium zone. Orders are caught here, then boom. Here, different concepts are being applied. You have inducement here, there's fair value gap, order block, breaker block. You need to learn things slowly before you can take good trades. You can't just sell anywhere directly. Where will you sell? You can't sell anywhere because everything is in the premium zone. Then the market fell from here or here or here. How can we know? We trade by combining various factors. Now look, this is a good setup. There's a fair value gap, breaker block, order flow, and the trend is down. And the market is in the premium zone too. So this is a great setup. Here, the market slightly tapped the bank's orders, then the market went down. Now, a new leg has formed here. I will mark it. I will bring this here. Now we will wait for it to enter the premium zone. We will expand the leg here. Then again, it will enter the premium zone. Boom. This is discount and premium here. You would be selling here, here, or here. But selling always happens in the premium zone and buying always happens in the discount zone. Equilibrium. We understood equilibrium. Equilibrium also has different types. Previous day equilibrium, PD, previous week equilibrium, PW, previous month equilibrium, PM. For example, we have a daily candle. We will draw a line at its low and call it the 0 level. We will draw a line at its high and call it the 1 level. We will find the equilibrium of the entire candle and the 0.5 level that forms here. This is the 0.5 level. Below 0.5, what do we have? Discount. Above 0.5, what do we have? Premium. Now a new daily candle has started. The new daily candle went down and it dipped into the discount zone. From here, institutional buyers caught in. The banks had limits here. They bought here, then the market boom went up and closed with a bullish candle. Now, this is our previous day equilibrium, the candle from the previous day. We will apply the Fibonacci tool above this, and its half will be where buying happens, which will be our discount, and above will be our premium. It is not necessary that buying happens every day. Buying can happen from the previous day's discount. I'm telling you this to set the narrative in the market. Now, consider this candle as a weekly candle. If the weekly trend is bullish, it will also do the same thing. The candle of the previous week in the discount zone will dip and buying will happen from there, then boom. You can also consider this as a monthly candle. If the monthly trend is bullish, it will also go up from the previous candle's discount. Now, there are two more types of equilibrium: order block equilibrium and fair value gap equilibrium. The equilibrium of an order block is called the mean threshold. The equilibrium of a fair value gap is called the consequent encroachment. Order block equilibrium, mean threshold 50%, and the midpoint of an order block is called the mean threshold. Let's look at an example of this. Here, we have the market. You will see the market created an order block here. We will draw a line at the low of this order block and call it the 0 level. We will draw a line at the high and call it the 1 level. Basically, we will apply the Fibonacci tool here, and its midpoint will be the mean threshold at the 0.5 level. What will the market do? The market will come down. Below 0.5, what do we have? Discount. Above 0.5, what do we have? Premium. What will the market do? The market will come down. It will go up from here, but it will not go up from here. Why? Because this is equilibrium for the order block. The market will dip to 0.5 and then go up from there. Guys, now let's look at an example of order block equilibrium and the mean threshold. The market was in an uptrend, so we will look for entries in the market. We will wait for the order block to form in the market. Here you will see two order blocks. One is here, and the other is here. There's no need to be confused. An advanced video on ICT order blocks is coming soon. The last selling candle and the last buying candle are not order blocks. In that video, I will explain every detail of the order block. For now, just remember that this is one order block and this is another order block. We've marked both. Which one is useful to us? The useful order block for us will be the one that is in the discount zone because we need to buy and we need to buy from the discount. We will mark from the high of this leg to the low. Where is the discount coming from? This is the discount. This order block is in the discount zone. We won't take an entry from this order block. We will look at this one. Now let's delete this one. We find the 0.5 level of this order block. From here to here, this is the whole order block. Its 0.5 level is here, which is the mean threshold. We need to take the entry here, buying below it. We will set our limit order here and wait for the market to come there. Now, if you zoom in, you will see that the market tagged our entry. The market came slightly into the discount zone and then boom. Institutional orders work like this. They take entries in very small areas and catch their move. Now, we can target this order block. We can target its high because we took an entry from the discount order block at the mean threshold in an uptrend. Let's see what the market does. Guys, here the live market is running. The market is finished here, but the live market is still active. This target will get hit in a week or two. Why? Because this is also an order block and it's a discount order block. The market has already reacted well here. The market can rise again from here and trade. There's also a breaker block here, which we will learn about later. All breaker blocks, mitigation blocks, rejection blocks, vacuum blocks, order blocks, fair value gaps. An advanced video will be made on each of these. I am also creating basic videos for you. Once you know the basics, such as premium, discount, today open gap zone, and all these concepts, you will be able to understand setups and strategies. So for now, just focus on building your basics. This was the example of the mean threshold for us. Next, we come to fair value gap equilibrium, consequent encroachment. The midpoint of the fair value gap is called consequent encroachment. Here we have the market. The market created a fair value gap here. We will mark it. We will apply the Fibonacci tool on it with the 0.1 and 0.5 levels. This gives us the consequent encroachment. Below this is the discount, and above this is the premium. The market will come down, dip into the discount, and then the fair value gap will push the market up. Boom. Guys, let's look at an example of fair value gap equilibrium. Here we have the market. Now look at this leg. There are so many fair value gaps here. This is a fair value gap, and here too there's a fair value gap, and this is also a fair value gap. Which one will work? I received a comment yesterday asking how to identify which fair value gap will work when there are so many in one leg. Let me explain which one will work. We will use the discount and premium here. From here to here, the green area is the discount and the red area is the premium. Now the fair value gaps in the premium zone we need to buy, so we will ignore these. These have no relevance to us. Now the fair value gaps that started in the small discount zone, this one, and this one are the ones we will focus on. Start from this fair value gap. Now look here. You will see that there's a breaker overlap behind us. We will mark it. This is the breaker overlap. An advanced video on this will be coming, so don't get confused. Now we have a breaker overlap, a fair value gap, a discount price, and an uptrend. So here we can take a buying position. Let's see what the market does. And another thing, the fair value gap in between here must be touched. It's not possible for the market to go up from here without touching the middle. I will zoom in and show you. It's not possible for the market to just go from here to up there. It must touch the middle, and I will mark it. This is our entry. Let's see what the market does. Here we got the dip. So look how simple this trade is. This is a proper setup. Right now I'm explaining the basics, and later advanced setups will come so you will understand it better. Don't just start looking at charts and buying where there's premium or discount. It doesn't work like that. You need to overlap other things. The narrative and market bias also depend on this. All of these things together will form your psychology. So what I need to do is create a checklist. These things must be in my setup, and based on that, I will trade. Guys, if you have any confusion regarding liquidity or inducement, videos on both are coming up. You can tap on them and watch. If you like the video, subscribe to my channel and share it with your friends. Goodbye.